The IRS will eventually force money out of your pre-tax accounts. That part is not optional. What most retirees never realize is there's a window, sometimes 5 years, sometimes 10, where you actually get to decide how much comes out and when. Miss that window, and the IRS decides for you. And by then, the math is a lot less friendly. Hi, I'm John Amarino, president of Securus Financial, and I've watched responsible, successful retirees lose tens of thousands of dollars to this, not because they made a bad move, but because they made no move during the one stretch of years when it mattered most. So stick with me. By the end of this, you'll know exactly whether that clock is already running on you. Here's what almost nobody explains. When you stop working, something quietly shifts on your tax return. Unless you have a pension, your paycheck is gone. Your income might drop, but your 401k and your traditional IRA are still sitting there, growing, compounding, building up. And the IRS is watching that balance just as closely as you are. Because at age 73, required minimum distributions, or RMDs, begin for most retirees, moving to age 75 if you were born in 1960 or later. And when they begin, the government decides how much comes out every year, whether you need the money or not. All of it is taxed as ordinary income. But here's the part that changes everything. In the years between the day you retire and the day those RMDs begin, you actually may be sitting in the lowest tax bracket you'll see. Your W-2 income is gone. Social Security might not have started yet. You might have a pension, which is usually lower than your old paycheck. So it's reasonable that you could be in the 12% or maybe the 22% marginal tax bracket after spending your whole working life in the 24, 32, or 35% bracket. And that is the window. And here's what most people get wrong about it. They treat it like a quiet waiting room before the real retirement begins. It's not. It's one of the most significant tax management opportunities you may ever get. Now here's where it gets dangerous. And this is so predictable, it's honestly frustrating to watch. Nothing feels urgent. The taxes aren't due, the required minimum distributions haven't started, and hopefully your accounts are still growing. Everything feels fine, life is good. And that feeling of comfort is exactly the problem. When nothing feels urgent, most people do nothing. They assume this is just what retirement looks like now and will continue to look like in the future. But that low tax bracket isn't always permanent. It's temporary. And every year you let it slip by unused, you're giving up tax savings you can never get back. Let me show you exactly how this plays out. Say you retire at age 62 with $2 million in an IRA. You delay Social Security to age 70. Your pension covers your expenses, life is grand. Those first years, your bracket might be in the 12 or 22% marginal tax rate. You're not touching the IRA because you don't need to. It feels comfortable because that's what you were used to when you were working. Having a steady paycheck and not touching your retirement accounts. And hopefully, those retirement accounts are growing. Feels smart, right? But here's why it isn't. Because now you're 73 or 75 and required minimum distributions begin. But your balance didn't sit still, it grew. And now maybe that IRA is worth $3 million. Your first required minimum distribution at 75 will be approximately $121,000. Stack your pension on top, then Social Security, and maybe even some capital gains. And just like that, you're potentially right back in that 32% marginal tax bracket. Not to mention your future Medicare premiums are going to go up because you're most likely in a higher IRMA tax bracket. And it doesn't level off, it compounds. Every year the required minimum distribution percentage increases. Hopefully your investments keep growing, but with that, the tax bill also keeps rising. So you went from paying a 12 to 22% marginal tax rate to paying a 32% marginal tax rate when you have no choice. And that's if they keep taxes at the low rates they are today. But here's the scenario that genuinely keeps me up at night. If you're married and one of you outlives the other, the surviving spouse is allowed to file married filing jointly in the year of the spouse's death. After that, they have to start filing as a single filer. So they may have potentially less income One Social Security benefit is lost, a pension may be reduced or lost, but your tax brackets and your deductions shrink, and you're left with a higher tax bill. Oh, and again, don't forget that your Medicare premiums will also increase because you're now in a higher Medicare tax bracket. It's what I call the widow tax. And what I say is the most egregious tax of them all. And the seeds of it get planted right here in this window during the exact years you could have done something about it. So if you're watching this and realizing you might be standing in that window right now or walking toward it, you're not alone. This is exactly the kind of situation we map out for our clients at Securus Financial. So if you want help analyzing your specific situation, click the link in the description to book a time with me. So what do you actually do with this window? Well, it comes down to 3 moves. And the third one is where almost everyone falls short. So the first move is to map your income bridge. Get crystal clear on what your taxable income actually looks like from the day you retire until required minimum distributions begin. What's coming in from pensions, Social Security, part-time work, dividends, and capital gains? Where are the income gaps? Which years are your taxes projected to be at their lowest? Those low years are your opportunity zones, and you can't use them if you can't see them. The second move is to fill that bracket on purpose. And this is where Roth conversions get powerful. You move money out of your traditional IRA, you pay the tax now at today's lower rate, and you put it in a Roth IRA, where it grows tax-free and qualified withdrawals come out tax-free too. You've taken that money from the tax forever pocket and moved it to the tax-free pocket. But here's what people get wrong. You don't convert randomly. You convert just enough to fill your current bracket without spilling into the next one. And if you're over age 63, again, you have to be aware of your modified adjusted gross income because these Roth conversions can trigger Medicare IRMA taxes. You see, what a lot of people don't realize, especially for a retiree, that every financial planning action typically comes with 2 to 3 additional reactions. But in this case, you're paying the tax, but on your terms, at a rate you choose instead of a rate that the IRS chooses later. The third move is the one people skip, and this is to stress test for survivorship. Run your numbers as if one spouse has passed. Watch what happens to that surviving spouse's taxes. If the survivor gets shoved into higher taxes by RMDs and Social Security, that's your signal to convert more aggressively now while you're still filing jointly. And almost nobody does this. And it's often where the biggest dollars are hiding. And if you have health problems, listen closely, because we have done this for clients who have unfortunately passed. If your situation is terminal and you have a year or 2 to plan for this, you need to be aggressive with your tax management and your survivor planning. Now, I want to be straight with you. This is not a one-size-fits-all planning strategy. Whether conversions make sense depends on your bracket today, your expected bracket later, your state taxes, your Medicare or state-ran healthcare premiums, your net investment taxes, and your health. The point is that everyone should run the math to make an educated decision before the window closes. Because once it does, you can't reopen it. And here's what I see far too often. Someone spends 40 years doing everything right. Saving, avoiding debt, staying disciplined, working hard, and then goes straight through the most valuable tax years of their life in retirement. Simply because no one told them of the retirement tax bombs and the clock associated with them that is running. By the time the RMDs hit, the conversation is about optimizing anymore. It's about damage control. And damage control is always more expensive. The IRS already has the schedule and the control. They know exactly when they're coming for that pre-tax money. Think of it like a football game. You won the first half in your accumulation years working hard, but you don't play the full 4 quarters. Who do you think wins? The IRS. So the only real question is whether you spend the years before then making smart tax management decisions on your terms at a rate you choose, or whether you wait and let the IRS set the terms for you. So here's what I want you to take away from this. The window between retirement and required minimum distributions is not a passive stretch of time. It's an active opportunity with a closing date. Cerulli and Associates, one of the most well-respected retirement research firms, has stated that retirees who work with a trusted advisor who proactively brings them these opportunities report significantly higher confidence and satisfaction in retirement. And retirement is not about big returns, it's about peace of mind. The retirees who use this window well may improve their long-term tax efficiency, building more tax-free Roth assets, and potentially improving the outcomes for the surviving spouse, while creating real flexibility in their retirement income. The ones who ignore it are often surprised by how much taxable income those required minimum distributions create later on. So if you want to see what this window looks like for your specific situation, book a time with me. The link is in the description below. See you on the next video.